Passive income is one of the most searched topics on the web today. And why not? Who doesn't want to make money while they sleep? For some people, the American dream is having the big house with the white picket fence. Others is just making money while you do nothing. And I'm sure you've probably figured this out by now. When you search for passive income, whether it be on Google or on YouTube or on iTunes, when you start listening or reading about all these different passive income ideas, a lot of them aren't that passive. They actually take a lot of work. So does that mean that you should strive to not achieve passive income? No, I 100% believe that you should try to achieve passive income, and not just from one source, but from multiple sources. But the thing that you need to know about passive income is that initially it's not passive at all. It takes a lot of work to get it running, to get it off the ground, to start generating any sort of revenue or income that actually has some sort of impact in your financial life. But without question, one of the easiest ways to make passive income is through dividends. That's right, through dividends. And today I want to highlight how you can start making $1,000 a month from dividends passively. And you're going to find out how to do that and a whole lot more on the latest Good Financial Sense podcast. This is episode 140. What is going on, GFC fam and Wealth Hacker Nation? It is your always cheerful, always grateful host, Jeff Rose, and we're recording another podcast, and we're talking about why wouldn't we be talking about this? Making extra money, how to make an extra $1,000 a month, but we're not talking about blogging. We're not talking about any sort of side hustle. We're talking about kind of an old tried and true strategy, and that is through dividend or dividend investing. Now, first things first, if you want to read more about all the information I'm going to cover in this podcast, if you're listening to this on iTunes, or maybe you're checking this out on YouTube, either way, we'll have a link in the show notes or the description that has a link to an article, an in-depth article on the blog Good Financial Sense, where we break down how you can start making $1,000 per month in dividends. Now, I'm going to go ahead and say this at the beginning because I think it is worth noting and worth saying is that if we start investing, so if you start investing, I don't care where you start investing. It could be through Robinhood, M1 Finance. Maybe you have a local Edward Jones broker. Maybe your bank offers investing. It doesn't matter. Wherever you start investing, if you think that you're going to start generating $1,000 a month immediately, that is not what I'm saying here. What I'm saying here is that through dividend investing over time, we can start generating that $1,000 a month through dividends. And once you do that, I mean, that is a lot of fun. And this is an experiment that I started with my Robinhood account. I've since moved on that strategy, got a little bit more into crypto. But as I started to do this, I started to realize, okay, this is possible. This is doable. But the key thing, like anything, especially when it comes to investing, is that you just have to start. All right, so let's go ahead and dive in talking about dividends, the ultimate source of passive income. But first, let's start with a definition of passive income so that we can all get on the same page of what that actually means. And there are a ton of different definitions. But let's just go ahead and use a very simple and concise definition. You can read this here on the blog post as well. So passive income is income received without any effort on part of the recipient. So that basically means that you're just chilling in your bed. Maybe you're even on the toilet. Maybe that's TMI. My apologies. Maybe you're chilling by the pool and you have that income coming in without little or zero effort. And when you think about it in that regards, there are very few investments that qualify. Sure, you have interest-bearing investments like CDs or savings account or U.S. Treasury securities. That could be like T-bills or even TIPS, Treasury inflation protected securities. Either way, if you are investing in any of these right now, you know that they're not paying you anything. Right now, you're lucky to get 1%. You're lucky to get even close to 1%. So that technically is passive income, but it is not a source of passive income that's really going to make any difference in your life whatsoever. If you really want to start generating any sort of income, it has to be through dividends, which we're talking about here, or some other source. That could be real estate, that could be some sort of online business. But right now, for the sake of this conversation and this podcast, we are talking about dividends. And there are many reasons that we could highlight why dividends are so awesome, but really thinking about this interest rate environment, this super low interest rate environment that we are in, the fact that you can make just on dividends, not including capital gains, but that you can make anywhere from 3 to 4% on dividends. And that type of dividend rate is for stocks that I would consider to be a little bit more, we'll say, on the conservative side. I mean, no stock is technically conservative, especially comparing that to a bank, like a CD or a money market. But for the most part, if a stock is paying a dividend somewhere in that 3 to 4% range, it's generally considered to be a more conservative, say like a blue chip stock. Now, there are more aggressive stocks that you can get that are paying higher dividends. That could be anywhere from 6%, 8%. There are even dividends like MLPs, master limited partnerships, that are going to pay in that 9, 10, 11, even 12% range. Now, typically with those type of stocks, you're going to have a lot more fluctuation, a lot more volatility, which basically means if you don't mind jumping on a roller coaster and just feeling your stomach like wee, to the highs and the lows, if you can stomach that, awesome, great. If not, if you're more on the conservative side and you don't want to see a ton of fluctuation, try to pick stocks generally in that 3 to 4% dividend range. Now, maybe you're already sold on the fact that dividend income, passive dividend income is awesome. Maybe you're already collecting dividends, so you see how incredibly impactful that could be on your financial life. But for those that are still not 100% decided, maybe the jury's still out for you. Let me give you 2 bonuses on why you should consider dividend income. So bonus benefit number 1 is capital appreciation. So this is really what makes investing, such a powerful tool. When you're investing and you're thinking about the dividend income, okay, that's great. You're making that 3 to 4% interest. But what also makes it powerful is capital appreciation. And that is just a technical word for saying that you're seeing the value, the price of the stock that you are buying going up. And I could use a ton of different examples. And actually, here in the blog post, we actually use an example. So let me just show you that example here. So let's take a look at Pepsi. Now, at the time of this, I don't know what Pepsi is trading at the time of this recording. I'm just going to use the examples used here on the blog post. But right now, Pepsi is paying a 3% dividend. The current share price, give or take, is $143. Now, this could be totally outdated, but just to kind of give you some sort of stock price reference. But let's say that you bought Pepsi stock 10 years ago, then you would have bought it for $65 per share. So think about that, right? You bought this stock for $65 10 years ago. You've held the stock. It's appreciated. It is more than doubled in value. So your initial price, your initial value that you put in has doubled. And on top of that, you're making a 3% dividend. I mean, that is like having your cake and eating it too. It's one of the purest and best examples of how to make money on dividends and how to make money, especially over the long term, in dividend investing. Now, Pepsi, that is a company that pays dividend. Not all companies do. There could be tech stocks like a Google or an Amazon, and they may have their special one-time dividends, but for the most part, that is basically you're buying a stock and you're going for just pure growth. Now, that's not a bad thing, but if you buy a stock, say, for, and 10 years later, it hasn't gone up in value, then wow, that didn't work out. In the Pepsi example, let's say that it was still $65 after 10 years. At least you still had that 3% dividend that was paying. At least you're making some interest on your money versus it just sitting there. So that's bonus benefit number 1. And if that isn't enough, let's just go ahead and give you bonus benefit number 2. And that is a favorable income tax treatment. Now, I'm just going to take a wild guess here. And I'm going to assume that you don't like to pay a lot of tax. If you had it your way, you wouldn't pay any tax at all. Now, the cool thing about dividends is that the way that the IRS treats them is that you get a nice little tax break. Now, you still have to pay some tax, but for the most part, compared to short term capital gains or even long term capital gains, which is debatable, that actually could be treated about the same rate. But for the most part, if you have to pay short term capital gains, that basically means that you are paying whatever your tax rate is. So if you are in the 25% tax bracket and you buy a stock, sell a stock, then you have to pay 25% tax on that gain. But with dividends, it's an entirely different story. So here is some of the current tax rates. So basically, if your taxable income is 78,750 or less, then you pay, check this out, 0% tax. 0% tax. If your income is between 78,750 to 434,550, then you're taxed at 15%, which is still a whole lot cheaper. And this is so if you're making $434,000 or less, paying 15% on your dividends, I mean, that is just, that's not a bad thing. That's a good thing. And the most that you'll pay is 20%. And that is, once again, just another benefit that makes dividends that much more attractive, even more attractive than just your basic investing. So if you are now on board seeing how important, how awesome, how cool dividend investing is, now you're probably wondering, okay, well, how do I find dividend stocks? Where do I look? And there's a ton of places you can look. You could go to Google, type in how to best dividend stocks, highest paying dividend stocks, lowest risk dividend paying stocks. I mean, you could search a variety of keywords to find some sort of list that's going to show you some good examples. And for the most part, like the stocks that you find are going to be companies that you are very familiar with, and chances are, you're already using, like you're already a customer of them, you're already a client. I'll be naming some companies here later on just to show you, all right, here's some real life examples of companies that you are probably already paying to use them. So why not, buy their stock, collect that dividend and help, basically you're paying them and they're paying you. I mean, that just works great, right? So one place that you could start is just looking at the S&P 500. So that is the top 500 US companies. Currently, the average yield on all the stocks included in the S&P 500 is 1.8%. Now, is that attractive? I mean, it's better than what your bank is paying. I guarantee you that. But you can start going down that list of the top 500 US companies that are all paying a dividend. Like that is one place to start. Another place to start, and I frequently talk about this just because in my own research, when I was trying to figure out where to find the best dividend paying stocks that weren't too risky, what I ended up leaning on or using as my criteria was the Dividend Aristocrats. So what is the Dividend Aristocrats? So right now, at the time of this recording, this is a current list of 65 companies that are all paying dividends. Now, to be included on this list of the Dividend Aristocrats, there is a lot of different criteria that you have to meet. And here are the ones I think that are probably the most interesting to you, and I know they were to me, as far as like why I wanted to use this list as my screening criteria. So first things first, any stock, any company included on this list has to have a history of paying its dividend for 25 straight years. And not just paying its dividend for 25 years, it's had to have a history of increasing that dividend for 25 years. So that is a big deal. They are all included on the S&P 500. So it is a top 500 US company. And even to make that list, like there's certain criteria. So you have to have a minimum market capitalization of $3 billion. So they're not a small company by any stretch. And then also have an average of at least 5 million in daily share trading value for the 3 months prior to the rebalancing date. So what does that mean? That means that there are a lot of investors, a lot of traders that are buying and selling this stock. That means that this is not some thinly traded security. This is not like some penny stock of a company you've never heard of. There is an active market for these companies, these stocks, which also should give you some reassurance. And this is not a guarantee by any stretch, but that they're not going to be filing bankruptcy anytime soon. Now, this is not any guarantee, but once again, when you are checking all these boxes for this criteria, that is generally saying that these companies have a solid track record. They have got a lot going on, and they're not some fresh startup that you've never heard of, and they're here today and gone tomorrow. Now, if stocks aren't your thing, you just don't trust yourself, or maybe you just think they're way too risky, there are other alternatives. For example, you can also just purchase high dividend exchange traded funds, or ETFs. And once again, if you want to find out this information, do a quick search for best dividend ETFs. There are tons of lists out there. I'll give you some examples here that you can check out. You have the Vanguard High Dividend Yield ETF. The symbol is VYM. That is one option. You also got the Spider S&P Dividend ETF. Symbol is SDY. And then you have the Schwab US Dividend Equity ETF. Symbol is SCHD. And here on the blog, we shared the returns over the last 10 years. You've got 10.45%, 10.23%, and 12.61, with dividend yields of 3.68, 2.91, and 3.69% respectively. So once again, even buying an ETF, you're still getting a very attractive dividend yield. I mean, the fact that you can buy this Vanguard High Dividend Yield ETF and it has a dividend yield of 3.68% and it's diversified. I mean, wow, okay, that's awesome. So that is another option. Something else that you can do if you want to go more towards the dividend route, then you could also do, more of the real estate route. Obviously, dividends, we're talking about dividends, but you could also purchase a real estate investment trust, or a REIT. Now, what makes REITs different, and with these typically you are going to see higher dividend yields, not always, but for the most part, typically yes. But with a stock to be classified as a REIT, they are legally required to pay a minimum of 90% of their incomes in dividends to their shareholders. That's how these work. That's how they operated, or that's how they have to operate. And there's other reasons that are beyond the scope of this podcast why this is attractive for them as a company to do this. But that is just what they do. That's how they get classified. And here are a few examples. We've got Brookfield Property REIT, symbol is BPY. Current dividend yield is 8.32%. Got another one, Kimco Realty Corp, dividend yield 2.81. And then Brandywine Realty Trust at 7.28. So as you can see, both the Brookfield and the Brandywine there, you got 8.3 and 7.28. That is a lot higher than that 2 to 3% that you typically would see somewhere else, even with a Dividend Aristocrat type stock. Okay, so now it's time for the nitty gritty. How do we start building a portfolio of dividend stocks or investments that is generating that $1,000 a month in dividends? Well, as we show here on the blog post, typically if you are making 3% on average, a 3% dividend yield per year, you're going to need a portfolio of at least $400,000 to generate that $12,000 you need for that $1,000 a month of dividend income. Now, if you think that building a $400,000 portfolio is impossible, you're probably thinking, well, then why bother? But the truth is that it can happen. It just, once again, all it requires is that you start investing. And we're also assuming here a 3% average dividend. If you want to sprinkle in some REITs in there, or some MLPs, some master limited partnerships, or if you want to go the crypto route and you want to invest into, some sort of crypto exchange that offers interest on their stable coins as paying 7% or 8%, there's a variety of ways that you can do this to get you to that $1,000 a month in dividends. So first, let me just show you a few examples. And I just pulled 10 different stocks from the Dividend Aristocrat list. And here's just some of the names: Archer Daniels Midland, you got Aflac. I cannot say Aflac without quacking like a duck. Aflac. 3M, Cardinal Health, Cincinnati Financial, General Dynamics, Coca-Cola. Also could have threw in GE, General Electric. Could have thrown in Verizon or AT&T. Those are some of the companies that I have owned at one time. And there's some dividend rates here, but basically took this and divided each of them, basically made it to $40,000 each. And with those 10 companies, the net dividend yield, or the average dividend yield, excuse me, is 3.2%, giving you an annual income of $12,792, which, if you're doing the math, is more than $1,000 per month. And I did not pick the stocks with the highest dividend yields. There are other stocks within the Dividend Aristocrats that are paying a lot more. And these are all, once again, subject to change. But at the time that we wrote this post, AbbVie was paying 4.9%. ExxonMobil was paying 9.42%. So there are definitely other stocks that you can entertain. Now, the other thing that you'll also need to know is when the stocks pay out their dividends, because they don't typically pay their dividends monthly. And there actually may be some exceptions to that, but for the most part, they pay them quarterly. So if you are truly trying to set this up where you're making that $1,000 a month, you'll need to know and find out, and you can find this on when you're doing research on any stock or any company, they'll let you know what the dividend schedule is. But just as an example here, in January, Cardinal Health pays out their dividend. In February, General Dynamics would pay out their dividend. Aflac pays theirs in March, so on and so forth. So you would need to try to stagger the companies that you own when they pay out their dividends so that you're getting that $1,000 a month, if that is truly a desire. I mean, if you're getting, let's say, all your dividend payouts in, say, the month of January, so you got your $3,000 in January and you don't have any more dividends coming in February and then March, then you just better learn how to budget so that you don't blow all those dividend payments that you made in that 1 month. For those that have not given up hope that it is not impossible to accumulate a $400,000 portfolio of dividend paying stocks, I'm glad that you are still here, because let me show you how this could work. So let's say, for example, that you start investing $500 a month, which is $6,000 a year, and you're investing that into a growing portfolio of dividend stocks with an average return of 10%. So even if you never increase the amount that you invest, so you're still doing that $500 a month, you'll accumulate this $400,000 in your dividend portfolio in just 21 years. And for the most part, that is not a long time frame. It just takes discipline. So discipline means that you start doing $500 a month and you don't stop. You don't stop because the market is down. You don't stop because the market is up. You don't stop because all of a sudden you used to watch Fox News. Now you love CNBC or MSNBC, and whoever you're listening to is telling you shouldn't invest. You keep investing no matter what. And then over time, it will happen. It may happen sooner. It may happen a little bit longer. But the key thing that you don't want to do is chase high dividend yields. I've seen so many examples, and I wish I could come up with one in particular, but I just know there were several clients I used to work with where they like, "Oh, Jeff, have you seen this stock? I mean, it's paying a 12% dividend." And I'm like, "Yeah, but have you seen the fluctuation? I mean, if it's paying 12% today, and let's say you buy it as a $20 stock, you're like, awesome, $20 stock paying a 12% dividend. Well, if the stock goes down to $10 or $5 and it never goes back up, it's going to take you a very, very long time to get back your principal, even if it's still paying out the dividend. Now, there are other examples where these higher risk stocks that are paying high dividends, if they drop in value, guess what happens? They may not stop paying their dividend, but they may decrease the dividend that they are paying. So now, crap, it's going to take that much longer just to recoup your principal. Sure, they're still making their dividend payouts, their payments, so you're still getting those dividends. But since you lost your principal or lost a good chunk of your principal, now we're not really generating income. Like, we're just trying to get our money back of how much we put in. And that is not a lot of fun. Promise you. I promise you that is not a lot of fun at all. So to wrap this up, I mean, if I've not said enough good things about dividends, dividend income, the other attractive feature with dividend income is that not only, I mean, typically when people are thinking about investing into the stock market, especially for the long term, like we're thinking about retirement, which makes a lot of sense. But the cool thing about dividends, since you have that favorable tax treatment, this is not only investing for retirement, but this is also investing for the short term, meaning that if you want to start drawing down the dividends now, and not reinvesting them, you can. So you can consider this as like this is your side hustle. I'm just using the dividends I'm making from my stock portfolio to help pay for the bills or help pay for the things that I want to do, like taking vacations or whatever you want to do. I mean, you can use that today. You don't have to wait until 10 years from now, 20 years from now. Like you can start living on that today. Now, initially, obviously, we talked about like that's not probably going to be a lot of money in the first few years, but after 5 to 10 years, if you're making an extra $200, $500, and you need it, then use it. If you don't need it, then just reinvest it back into the stock so that now you're buying more stocks, which are paying you even more dividend. And that is the beauty of compounding interest. Arch, I hope you enjoyed this podcast. Until next time, this is Jeff Rose reminding you that it's your money, it's your life, and only you can make it awesome. Until next time, peace.